Today we're going to take a look at a few multi-time frame candlestick trade ideas and strategies, and I will show you exactly how to approach a chart top down, how to use the best candlesticks, and how to find a perfect entry on the lower time frame. The inside pin bar is the next pin bar variation, really interesting one that's often overlooked. And we are starting on the higher time frame. This is a day trading approach, so our higher time frame is the 2 hour. And what do we have? We have a higher time frame uptrend, a very long uptrend. Then you can see we have an inside candle after the bullish candle. Then this is our inside pin bar. So what do we have? This is a very important analysis. The red candle here closed at this point at the low of the body. The pin bar opened here, it moved higher, closed first of all the gap, was failing to make a higher high, then closed all the way at the bottom of this candlestick. So already this tells us quite a lot. First of all, we have the successful gap close, so we don't have to worry about that anymore. We have the failed rejection of the highs, and we have here the turnaround closing completely at the bottom. At this point, I would be very happy to jump on the lower time frame and look for shorts. On the lower time frame, you can see this is what we have. We have a trend line. We can see we have the breakout out of the previous highs. We have a triple top. We have a lower high. This is where you can see the nice confirmation of the gap. Here's the gap. The market closed it, failed to make higher lows, trading back into the lows. So at this point, our trading plan would be we need to wait for the market to get below this area. We also want to make sure that we are trading below the trend line. That's very important. Don't get into a trade where a trend line hasn't been broken. There's a high likelihood that the market may bounce, and then you're in big trouble. You can see the trend line was never really fully broken or not actively broken. What happened is that the market, after establishing here the support level on the trend line, is now having here a very hard time moving lower. You can see we established the support level here at the trend line. Here we had a fake out, and then the market is now moving into the level with a lot of confirmation and a lot of bullish force. So you want to really make sure to avoid those fake outs, and they can be avoided very simply by just not getting into a trade until the market had fully closed beyond such a breakout level. And this is what would have happened afterwards. We start the wave count here, wave 1. Wave 2 is a beautiful flag pattern. We're able to draw a trend line here. We have our triple high here. Previous support turns into resistance. If you miss the first initial breakout, you wait for this pattern to emerge right at the previous retest area, and then you wait for the market to get out of the trend line and out of the flag, and you have another confirmation. And you can see a very nice trade context. It all started with this nice pin bar. We drop to the lower time frame. We make sure that we know when we want to get in and when we don't want to get in. We are very patiently, we avoid fake outs, and then this is what we end up with. Another engulfing candle, however, this time in a 1, 2, 3 context, so a different context. And what do we see here? We see, first of all, the higher time frame. And on the higher time frame, you can see that the market, again, is in a very mature trend. 1, 2, 3, 4, 5, 6, 7, 8. So depending on how you want to count all of this, you are definitely at least beyond wave 7, maybe wave 8. And what do we see here? We see that the market is failing to make a higher high. We haven't made a full lower low yet, but we're trading in this range. And this is an inside range. You can see when we look at the last impulsive candle, all of the candles here that followed afterwards are inside this range. This is obviously not a very strong bullish signal. And if you are long in this trend, you definitely want to think about either scaling out of your position or closing it completely, because now the odds are not looking too good anymore. It's obviously way too early to short this market, but we can slowly get a short bias. And we see here the engulfing candle, and now we would drop to a lower time frame. This is how the situation looks on the lower time frame. We see we have lower highs. The 1, 2, 3 pattern would be completed if the market breaks here into the low. We would be breaking support, and then we look for a short here. And you can see we have that. We have the breakout of the support. We come back into the range, retest this area, and then momentum kicks back in. How do you trade such a market? There are a few ways how you could approach such a retest. So a blind retest would be if the market breaks below the support level, you are now here. Then you put your pending order right at the dotted line where the previous support is. In my experience, those breakouts are low probability because there's a high chance that the market will go against you and fall back in the range. You don't have enough information on your side. A much better entry would be here on the red candle. What do we see? The market went back in the range with a high momentum green candle and then fell back below. So at this point, we have now rejected here the range. We're back outside. Another entry, a little bit later here in this candle, we are breaking below the lows. At this point, because this is a very strong bearish candle, you may not get the best reward to risk ratio because you're forced to put your stop loss back in the range, and then you have a very wide stop and your target may not provide a huge reward to risk ratio. However, if the next candle after the rejection candle wouldn't be as big, that is often also a great entry opportunity. So if you're waiting for a pullback, sometimes it's important to note and understand that the market will just take off without you. This is the nature of pullback trading. So the aggressiveness of your pullback approach, how early do you get in, determines also how many of those trades you will miss. It also determines your win rate and also the reward to risk ratio. The earlier you get in, usually the better your reward to risk ratio. However, the lower the win rate. That's generally the trade-off, and I've made many videos about this trade-off. Let's talk about the tweezer and what it is. First of all, higher time frame. This is where we see our candlestick. We are in a mature downtrend. We have a tweezer, and a tweezer is basically nothing but two pin bars right after each other. So first of all, we have a bearish pin bar, then we have a bullish pin bar. Both have a very, very long wick and both have a tiny body. The green pin bar has obviously a higher close than an open, and this would then set the stage for the lower time frames. At this point, we would look for long opportunities. So on the lower time frames, this is what the tweezer looks like. We have the triple top from the tweezer. We have also a very, very nice level that we can use. Previous support turns into resistance and resistance and resistance. What do we have also? A lower bounce. The market now, after hitting the level here, is not able to pull away. So it's staying very, very close to the level. This is, again, a sign that a lot of pressure is building here below the potential breakout point. It's not enough to just jump into a trade right away and buy just because you see a build-up happening. There's a chance that the market will reverse, but you can greatly improve the chances of finding a better opportunity by just waiting for the market to get above this area. It's also the round number 1.89, so that is also great confluence, and you want to make sure that the market breaks such confluence levels before you're in. And you can see the market broke this area, wasn't able to move away immediately, but you can see we have a retest and then a continuation. This is very important here because what is very common in those markets is a pullback. So here's where a lot of breakout traders will get in. They see the market is moving in their favor. What are they doing? First thing, move the stop loss to break even, and then they get taken out. In my trading and in my students, we do move stops, we do protect our position, but you put them at a place where it does make sense. A break-even stop in the most cases doesn't make any sense because a break-even stop, if you get in here, is not protected. It is right in the middle of the trade. And this is not an area that I wouldn't be surprised to see retested. So I wouldn't put my stop at an area where I expect to see retest. That just wouldn't make sense. I would move my stop loss maybe a little bit closer to the breakout area. If I see that the market has trouble taking off here, I may be ready to scale out a little bit to reduce the risk as well and then scale back in when I see continuation breakouts. But moving a stop loss to break even just for the sake of break even is usually not the best move. And here we have a super interesting inside pin bar trade study. We're starting on the higher time frame, 4 hour. And what do we see? We see that the market maybe have been trending lower, but it looks more like a range market. And it seems to have a tendency of, after breaking a low, like here, it shoots back up. It broke the low here, it shot back up. It seems to be breaking the low here, but let's see what is doing it now. You can see the market is this point, looks like it made a inside pin bar. So it's not enough to know that the market or whether the market will go up or down. Obviously, we just have a single pin bar. So it's an inside candle. It shows kind of rejection here in this range. So let's jump to a lower time frame and let's see what do we have. And in this market, you can see after the breakout here, we have now this triangle. A triangle is a neutral pattern and the market could go either way. So if the market jumps back above this dotted line, which would be here our previous low, we maybe start looking for long opportunities. However, if we get below the lows here, then we can start looking for short opportunities. And in my experience, what is often very helpful if you create trading plans on the lower time frames is that you stay open-minded for both long and short scenarios. You ask yourself, what would happen that would make me go long? And at the same time, what would happen to make me go short? And what I found is that it keeps you a little bit more open-minded. You're not locked into just one trade scenario, and you're not getting married to one trade idea. You can see afterwards the market moved into the top of the triangle, eventually broke out, and then moved lower. So we at no point did the market get back above the dotted line here. We didn't see a fall back into the range, and this is then how it played out. So a very nice trade study. Pin bars in general are great, but as I said in the beginning, candlesticks in general on their own, I don't think they work the way most traders believe they do. However, with context, with the right higher time frame, with the right lower time frame trading plan, you may find great trades using such an approach.